So to start this course, let's go over market structure really fast. Here you have your swing high. Once your swing high is broken, it forms your swing low. Once price comes back into the range, that forms your new higher high. And once your higher high is broken, that forms your new higher low, and so on, so on. So this will be basic structure. So now that you understand what market structure is, on a basic note, you need to understand that market structure must be broken into two sectors, which is your macro and your micro. Your macro would be your higher time frame, and your micro would be your lower time frame. So let's say in this instant, these three swings here are on your daily time frame, and price is bullish. But on the micro, this is what price is doing, forming micro swings, forming higher highs. Then when it's time for a pullback, pulls lower lows. Then changes character, starts forming higher highs again, and changes character again and goes into a pullback of lower lows. And as you can see here, price was bullish here and bullish here during the expansion after the reaction from a discounted level. But during the pullbacks, price was bearish. Price was bearish during this pullback, and price was bearish during this pullback. So the reason sometimes traders have trouble is their time frames are not aligned. If the macro time frame is bullish, you want to make sure that the micro is aligned with your macro. We are looking at the macro, which in this case would be the daily. And what do you see here? You see consecutive higher highs. You see a high being made, price comes back to a discounted level, forms a higher high, comes back to a discounted level and forms a new higher high, comes back to a discounted level and potentially make another higher high. So now that we can see this, let's mark our swings. You have your swing here, your swing high, and here you have your swing low. Here you have your higher high, and here you have your higher low. And here you have your higher high. So now that we know the macro is bullish, let's go to the micro, which in this case would be the 8-hour. And what do you see now? What you see now is consecutive pullbacks. You see multiple complex pullbacks, making new structure, making lower lows within our initial structure. Now a change of character, forming higher highs. Now price changes character, goes into a consolidation, starts forming lower lows. Change of character, now it forms your higher highs. Even though this is not perfect structure here, the price went into a consolidation, price is still in a bullish trend. So what do I mean by having your time frame aligned? The fact that we know our macro is bullish, we need to wait until our micro is bullish too. And at what stage here is our micro bullish? Our micro is bullish when price comes and reacts from a discounted level, forming the pullback of your macro structure, which would be this pullback here. Once price reacts and changes character, this would be bullish micro structure, which is in line with your macro bullish structure, forming higher highs. Now price goes into a pullback here and starts making higher highs here. And this is where both of your time frames are in line. So how can we use the information that we learned so far to anticipate potential order flow? So here you have your macro swing high and swing low and a new swing higher high been formed. And you can see the price came back inside of the range. So first thing you want to do is you want to locate your range. So this was your previous high. And this was your low. So now the fact the price took out this high and came back into the range, this would be your new high, and your low is the same because this is the low that forced the move to break the previous higher high. So now that you have your new range, you'd want to pull out your fib broken down into 4 levels, into quarters, into 0, 25, 50, 75, and 100. And you want to locate your discount. What would be your discount? Your discount would be your lowest quarter, which is where price would be the cheapest to buy, which would be this area. So now what you want to do is you would want to highlight it. So now that you have your discount level highlighted, what you're waiting for is you go to your micro and you want to see if the delivery is valid. So you want to see a lower low delivery approaching this level and a change of character occur. Price is making lower lows and lower highs. Now, once price approached this area, it rejected and expanded, formed a what? A break of structure. What does this break of structure indicate? This break of structure indicate a sign of strength. That means now a potential order flow change will occur and your micro would be in line with your macro, which is bullish. Price rejects from the discount, which would be your return to origin, and makes a new higher high. So now you can confirm that the order flow is bullish on both time frames. And this is where you have the highest probability as far as anticipating your order flow, your true order flow, which is your micro and your macro being in line. So let's talk about when the price is not trending and decides to go into a consolidation. Here you have your range, you have your swing high and your swing low. So therefore, you want to mark up your range extremes, which would be your premium and discount. Here you have your discounted zone, and here you have your premium. So let's say price rejects from your premium, but fails to break your discount and rejects from the discount. This would insinuate that a consolidation is on the way, and expect price to bounce between these two extremes until it decides a direction to break into. So let's take a look at this example. You have your consolidation stuck in between these two swings. So what were the early signs that this was a consolidation? Look at your initial two swings and look at the first rejection from your extremes. Should be here and here. And where did these levels reject from? Your extremes. And as you can see, once the consolidation was established, price continued to bounce off these levels multiple times until price decided to break out in a specific direction. And the easiest way to trade this is to take a buy or a sell, depends on what zone you are in. So let's talk about the basics of liquidity. Conceptually, what is liquidity? Here you have price pulling back to a specific area and price expanded from that area. So what does that indicate? That indicates that price was purchased at this area. And if retail traders purchased this price alongside the institutions, where would the stop losses be? Stop loss would be here or here in the previous swings. And this is what you would call liquidity. And these areas will be eventually attacked by price to absorb the stop losses. So an easy way to understand this is look for places where business was conducted. As you can see here, price was sold heavily. That means that somebody purchased price right here. So next thing you'd want to do is you want to look at context based off what this price was sold. So you always look to the left. And in this case, you can see this base that previously had a resistance level. So price was sold at this level with a lot of selling pressure that even broke structure. So now you know that if price does come close to this area, or at least comes close to revisiting it, price will more than likely break through this area and continue above. And this area will act as a magnet. So now this area acts as a magnet. So when price does revisit this area again, expect price to shoot through it and continue or stop hunt. So to keep liquidity simple, here's an illustration. You have your swing. Price approaches your swing and rejects, showing proof of heavy selling pressure. And the stop losses from this transaction would be right above those two swings. So eventually, price would be inclined to attack that level and absorb the liquidity. So how can you use liquidity in your favor? You can use liquidity as a magnet to anticipate where price wants to go. And going on based off that, you would look at the entry you would pick. So in this case, you can see price moving from a demand level, and the target is your liquidity. So there are other types of liquidity. In this example, we're going to cover the FTB, fail to break. Here's your point of interest. Price approaches and reacts. So anybody that's sold at that point of interest, their stop losses would be at that previous swing. And this swing will act as a magnet. So price will eventually visit this area to absorb the liquidity. So here's an example of your FTB liquidity. Point of interest been formed at the extreme. And price approaches the level, showing a significant reaction validating your liquidity. And price will eventually attack that level. So another form of liquidity is your trendline liquidity. So price rejecting from your trend line, which means that somebody purchased price at that trend line and their stop losses would be beneath the trend line. So the trend line would act as a magnet. So here's an example of trendline liquidity. Price finds resistance in your trend line, which will make your trend line the liquidity. So how can you use liquidity as a target, as somewhere where price can potentially go, and how to use that with your entry? So one way to use it is to use it as a destination. So let's say here you have your relative equal lows. They're not exactly equal, but they're relative. And what you would want to do is, you know that this area will attract price. So the fact that now you know that this area acts as a magnet, you're looking for a reason to take price down. You're looking for a reason to get in a short setup, with this being your target. And use a discounted level. You could use this entry, or you could maybe use any other form of smart money entries that we're going to cover going on in this lesson. But what you basically want is a reason to go short. Why would you need a reason to go short? Because you have your liquidity right here pulling price. Price is attracted to this level. It just needs a reason. And what you do is, as you find your entry, make sure you have a liquidity as a target to at least have a attracting force power that it wants to attract price away from your entry to your liquidity level. So here is one of the most powerful types of liquidity when two liquidities correlate. So here you have your relative equal highs, and at the same time you have your FTB, which is right here. Price failed to break. It came to this area and reacted with a strong reaction, validating this, and these relative swings, including this swing, validate the relative equal highs. So now you have a strong level of liquidity. So what you're doing is, you know that price will be attracted to this level. At some point, price would want to attract to this level. So what you want to look for now is your entry. And of course, we're going to cover entries as we proceed in this course. But for now, let's just keep it simple to a premium and discounting level. Here you have your levels. Why do we pick this level? Because of your last swing low prior to the structure break. And why this would be a good level? Because you know that price is already attracted to our liquidity. Price needs a reason to pull here. So when you look for entry, you're looking for a reason to take price right here. So another function of liquidity, aside from attracting price, is that it can be purged. A stop hunt can occur. Let me show you. Here you have your liquidity formed, and we know that this area will attract price. But instead of price just ripping through that area and continuing, price comes back into the range, forming a stop hunt. What's a stop hunt is taking everybody's stop losses and going the opposite direction. One example of this is, here you have your liquidity. You have two equal lows. And you know that price is attracted to this level. So instead of price going through this level and just continuing lower, by just running through it, price will take this level and come back into the range to continue with the direction it originally intended. And this is what you call a stop hunt. Price takes retail stop losses before going the opposite way. So the sole purpose of a purge is to take out the liquidity. So since this is an advanced version of a smart money course, we're not going to waste a lot of time covering the basics of an order block and what an order block is. I expect you guys to notice as you're stumbling upon this course. So we're going to start off with advanced order block. So here is your macro order block, which would be your higher time frame order block. And this is how this order block would look on the micro, on the lower time frame. On the lower time frame, this is what we would call a shelf. The shelf represents the entire area where business was conducted, even though you would try and shrink it or look for a micro order block on the higher time frame. That is the initial order block. So the entire shelf area is where business was conducted. So what a shelf is somewhere where business was conducted. Price was bought or sold. So let's take a deeper look. You have a break of structure. Something forced price to push up, impulsively push up. That means this business was conducted in this area. So our next step is to find exactly where in this area business was conducted. And we're going to get into that as we proceed with this course. So in this area, there are buy orders. Buy orders were injected here to push price above its previous structure. And price can head back to this area and reject anywhere in this space. It could be here, here, or here. So let's talk about shelves and order block selection. You have price consolidating, and you got an expansion. So once price broke structure, your next question is, what made it break structure? Where did all this buying power come from? That means within your shelf, buy orders been injected to push price to rally. And buy orders were injected throughout this area. So your next step is to look at your order blocks. Order blocks that you can find within the shelf. You have one here, one here, and another one here. So you have 3 order blocks within your shelf. And let's go about order block selection. The strongest order block that you can get the strongest reaction out of would always be the one prior to the structure break, the one responsible for the biggest move. So in this case, it would be the first one. Your second order block is your fair price order block. And the safest order block you can take is always your deeply discounted order block, which would be your third. So let's talk about valid and invalid order blocks. So here you have your shelf, and here you have one valid order block. Here you have your second valid order block, and here you have your invalid order block. Why is it invalid? Because it's a mitigated order block. What does mitigated mean? That means it's already been used prior to the shelf forming. So this order block is no longer valid, and if price does approach this level, it will more than likely run through it. So this invalid order block, mitigated order block, turns into liquidity. So our next step here is to combine liquidity and order blocks. And how we're going to do that? We're going to do that through inducement. So what is inducement? You have your point of interest. Price approaches your point of interest but does not make contact and reverses, forms a new point of interest. So now what price would do is blow through your new point of interest and go back to the initial one, react from it, form a purge. What is a purge? A liquidation. And where is the inducement? The inducement is the fake point of interest. That minor swing that headed to your point of interest but reversed before. And its sole purpose was to induce traders into taking positions earlier than their initial point of interest. So here is where we're going to combine liquidity and our order blocks. So here you have your point of interest, which would be your order block, and price approaches, forms the inducement, and forms liquidity. So now what you're waiting for is for price to run through that liquidity and reject from your order block, forming your purge. You have your point of interest being formed. Now it's time for the inducement. You have your equal lows for price to take out that liquidity and use your order block as a rejection. So here's an example. You have your inducement right here. Here's your inducement, and here is your point of interest. And you would expect price to absorb the liquidity beneath your inducement and attack your point of interest, which would be your order block. So not only you can have a equal lows or equal highs inducement, you can have a FTB inducement like we covered initially in our liquidity section. So here you have your order block. You have your fake out swing, which would form another order block. So when price approaches this order block and reacts, it forms your FTB, or fail to break. So now that we know there's liquidity underneath the swing that formed the second order block. So price will go to your initial order block. Here is an FTB inducement example. Price forms your order block, forms your inducement, and comes back to reclaim the order block. So let's talk about volume gaps. So volume gaps are these gaps where price action doesn't cross path. So as you can see here, price action wigs back and closes all these micro gaps. Right here, this wick closes all these micro gaps. But then you have these gaps that are wide open, and this is what you call a volume gap. it shows strength. It shows a lot of orders been injected where price couldn't catch up with the post pullback. So here you have a gap. And here you have another gap. And here you have another gap, and so on, so on. So what is the purpose of these gaps, right? These gaps must be filled, and you can use these gaps as a target. As you can see, if you stretch out these gaps do eventually get filled in. You see here, this gap got filled. It didn't get filled all the way, but then eventually got filled all the way and then reversed. Same here. This gap got filled, then reversed. This gap didn't get filled, retraced. That means price will come back to fill up this gap. So the golden rule here, without taking too much time into this, is these gaps must be filled. All these little gaps, they get filled. So your best inducement purge setup going onto your order block is when your purge fills in your gap. So here you have a gap that your purge fills in. So it's another context to your entry. So not only that you have your inducement and you have your order block with a severe reaction, now you have your volume gap that must be filled. So that's another context to your trade. So let's talk about breakers, which is your supply turn into demand or demand turn into supply. So here you have your order block, and price approaches this order block, but viciously breaks through it. So now, what's the first sign that this supply can turn into a demand? Your first clue is the reaction. This strong reaction. Price did not come up here, reject, came back down, rejected multiple times, and then broke. From its first attempt, it broke out fully. Your second clue is that this gap was not filled. You see price here? It did not close this gap. The gap was from here to here. And price did not close this gap all the way. So that means that price did have motive to react from this level, but failed. And so what does that mean? That means that there was sell orders here, but they were overpowered by buy orders that were injected here. So that means there was more buys than sells. So that means this area, as price was going through this area, sell orders were getting absorbed and more buy orders were getting injected. So when price does come back to this level, you can expect a rejection from all the buy orders it took to break through this sell zone. Hope you guys enjoyed this course. Make sure you like, share, and subscribe. And if you made it all the way to the end, make sure you comment SMC Advanced completed.